Hello there. This video is the first in a set of 7 videos where we learn management accounting in under 2 hours. Usually, a course on management accounting is taught after a financial accounting course, so a basic understanding of the various financial statements is considered a prerequisite for this course. To begin with, we are going to see how management accounting is different from financial accounting. Under financial accounting, the various financial statements that are created regularly, maybe on a quarterly basis or an annual basis, these statements are created for external users. By external users, I mean investors or potential investors who might be interested in understanding the performance of the firm, or the government, for example, for regulation or taxation purposes. So these financial statements, such as the income statement or the balance sheet or the cash flow statement, provide information about the actual performance of the firm. How much revenue has the firm earned in the past quarter or year or over the past 5 years? How much is the inventory of the firm? Is it going up or is it going down over the past few years? These type of analysis can be performed by looking at the financial statements under financial accounting. These financial statements should follow US GAAP or IFRS standards so that the information being reported is reliable and can also be used for comparison purposes with other firms. But on the other hand, management accounting is primarily used for internal purposes. It's used for managers to make better decisions. Managers typically create budgets and other cost-based reports to plan for the future, and because these reports are internal, they do not have to follow any particular standard as such. They are developed mainly for the sole purpose of better decision making. Management accounting can also be sometimes referred to as cost accounting because most of the reports and analysis performed under management accounting revolves around management of costs. Moving on, we are going to look at some of the basic terminology which will help you understand this course on management accounting better. First, we'll look at what direct and indirect costs are. Direct costs are costs that can be directly attributable to a particular product or a department. For example, material or labor costs that can be directly attributable to a particular product are considered as direct costs to that product. Other overhead costs such as rent or utilities or marketing expenses, which may not be directly traceable to a particular product, are referred to as indirect costs. These indirect costs might have to be allocated to different products or departments to understand better the profitability of these products. So in a broader sense, what decides whether a particular cost can be classified as direct or indirect? First, it depends on the materiality of this cost. If a cost is highly insignificant or it's much harder to trace it directly to a particular product, then this cost is typically considered as an indirect cost. Okay? Sometimes this depends on the technology available to classify this cost too. Consider the salary of a branding manager, for example, who is responsible for branding several products. It's impossible to trace the salary of this branding manager directly to the different products he's working on. Okay? So in that case, the salary of this branding manager is considered as an indirect cost. Finally, how an operation is designed can also decide whether a particular cost is direct or indirect. If a plant had been designed to produce only one type of product, then expenses related to that plant are directly traceable to that product. In that case, all the expenses related to the plant are classified as direct costs to that particular product. But if a plant had been designed to produce several products, then the rent of this plant may not be directly traceable to the different products. In that case, that's considered an indirect cost. Next, we are going to look at what fixed and variable costs are. Fixed costs are costs that do not change regardless of the level of output. So regardless of whether you produce nothing or you produce 100 units of something or 200 units of something, the cost is always going to remain the same. Okay? These are fixed costs. But you have to always keep into consideration that there's always a range within which a cost remains fixed, right? For example, if a factory is capable of producing 1,000 units of something, okay, then the costs remain fixed only until the production of 1,000 units. If you want to produce more than that, you might have to establish a second factory or look for some other investment in order to meet these expectations. A typical example for a fixed cost might be rent, which does not change depending on how much you produce. On the other hand, variable costs are costs that change with the level of production. Okay? A typical example of variable cost can be material used, okay, which changes depending on how much you produce. Okay, the more you produce, you might have to use more material. Okay, using an example, you're going to look at how fixed and variable costs behave from the perspective of total production and also from the perspective of a single unit. So we'll look at this hypothetical example where we are going to understand fixed and variable costs for a range of production. Okay, we are going to look at what happens when no units are produced, or 1 unit or 2 units and so on are produced. Okay. Let's assume that the fixed costs are $200. Okay. So no matter how much you produce, you will still have to pay these fixed costs of $200. Okay. Let's say the unit variable cost of production is $10. Okay. Each unit you produce will cost you $10. Okay. Now we're going to calculate the fixed cost per unit. Okay. So I'm going to take my total fixed cost and divide that by the number of units being produced. Okay. Then I'm going to calculate the total variable cost. Okay. Which is basically the unit variable cost multiplied by the number of units being produced. Okay. Again, I click and drag for all the units. Okay. How do I calculate the total cost involved in the process? I add the total variable cost with the total fixed cost. Okay. That gives me the total costs involved in the production process. Okay. Now I want to find the total cost, but at a unit level. Okay. So I basically take the total cost and divide it by the number of units that are being produced. Okay. Now I'm going to create a chart so we can visually see and understand some of these variables. Okay. Insert recommended chart. So the blue line here represents the total fixed cost. Okay. You can see that does not change depending on how many units you produce, which is shown here on the horizontal axis between 0 to 10. The orange line represents the total variable cost. Okay, you can see that keeps increasing with the level of production. Okay, the gray line represents the total cost of production, which is basically the sum of the blue line and the orange line. But the more you produce, fixed cost per unit keeps going down due to economies of scale. Okay, and hence the total cost per unit also keeps going down the more you produce. But as we discussed earlier, fixed costs remain fixed only within a relevant range. If you want to produce at a level outside of this relevant range, then you might have to consider adding more fixed costs to your production process. Next, we are going to look at inventoriable and period costs. Costs that become part of the inventory during production and which transform to the cost of goods sold only when the product is being sold are inventoriable costs. On the other hand, costs which are directly expensed in the profit and loss statement as and when they are incurred are known as period costs. We'll understand this better with an example. Let's assume a firm produces 10 units of something. Okay. The inventoriable cost per unit, let's say, is $100. Okay. The period cost is $500. Okay. Let's assume that the firm manages to sell only 8 units during that particular period. Let's also consider that the selling price of this particular product is $300 per unit. Now let's ignore the 8 units being sold for the time being and focus on the 10 units being produced. So this $100 of inventoriable cost per unit, okay, becomes $1,000 because 10 units are being produced. So when you produce these 10 units, your inventory section under assets in your balance sheet increases by $1,000. But you also incurred a period cost of $500. Okay, this does not go to the inventory, but this directly is expensed in the profit and loss statement. Okay, none of the units have been sold so far, so our revenue is 0 as of now. Okay, and your operating profit, which is your revenue minus all your other expenses, is right now a negative 500. But now let's consider the 8 units that are being sold. Okay, so when you sell these 8 units, those 8 units are removed from the inventory, okay, and they are expensed under the profit and loss statement as cost of goods sold. So what's the cost of goods sold is the 8 units multiplied by the inventory cost per unit. Okay, now what's left behind in the inventory is just the 2 units which are not being sold. Okay, so 10 minus 8. Okay, so your inventory is valued only at $200 right now. Okay, how much is your revenue for the 8 units you sold? Is the 8 units you sold multiplied by the selling price. Okay, so we can see that inventoriable costs are costs that are not directly expensed when the production takes place, but rather they are expensed only when the product is being sold. But on the other hand, period costs are expensed directly in the period in which they are incurred. For example, let's consider marketing expenses. It's impossible to trace marketing expenses to the different units that are being sold. So it's much simpler and more accurate to consider that the marketing expenses of this period benefit everything that's being sold in this period. So it's really not necessary to trace marketing expenses to each individual unit that is being sold. So to simplify the overall process, period costs are directly expensed in the profit and loss statement. Period costs are also costs that are highly regular, right? For example, rent. It's something you pay every month regardless of how much you produce. So to keep things simple, rent can be considered as period costs for each of those periods. But looking at things from a financial accounting perspective, keep in mind that your assets can be overstated or understated. Your total profitability can be overstated or understated, depending on which costs you classify as inventoriable and period costs. In the next session, we are going to look at CVP analysis, cost, volume, and profit analysis. We are going to look in a bit more depth about cost management. Thank you for watching. Cheers.